Welcome to SS2 Accounting. Today we study the dissolution of a partnership, the process of winding up the business, realizing the assets, paying off the liabilities, and distributing the remaining funds to partners. Dissolution is governed by the Ghana v. Mari rule for capital deficiencies. Understanding dissolution is essential for WAEC accounting. A partnership may be dissolved for several reasons. 1. By agreement, all partners agree to end the business. 2. By notice, in a partnership at will, no fixed term, any partner can give notice to dissolve. 3. By fluxion of time, fixed-term partnership ends naturally. 4. By death or bankruptcy, unless the partnership deed provides for continuation. 5. By court order, if a partner is mentally ill, guilty of misconduct, persistent breach of agreement, or if it is just and equitable to dissolve. 6. When the business purpose becomes illegal. When a partnership is dissolved, a realization account is opened. This account records all assets of the business transferred from their individual accounts. Proceeds received when assets are sold. Cost of realization, legal fees, auction cost. Any liabilities settled at different amounts from book value. On screen, realization account format. DR side. Book value of all assets transferred in, except cash/bank which are already realized. Dissolution cost. CR side. Proceeds from asset sales. Liabilities transferred in at book value. Profit or loss on realization. The profit or loss on realization is shared among partners in their profit-sharing ratio, credited to partners' capital accounts, if profit, or debited, if loss. When winding up, liabilities are paid in this order. 1. External creditors, third parties, trade creditors, bank loans. 2. Partner loans, amounts loaned to the firm beyond their capital. 3. Partners' capital accounts, in proportion to their capital balances. 4. Any surplus, shared in profit-sharing ratio. Partners' capital accounts are last because partners bear the risk of ownership. Ghana v. Mari is a landmark English case, 1904, that establishes what happens when a partner has a capital deficiency on dissolution. Their capital account has a debit balance, they owe the business more than they contributed. The rule states, if a partner cannot pay the deficiency, is insolvent, the other partners bear the loss in proportion to their last agreed capitals, not in profit-sharing ratio. In Nigeria, this rule applies unless overridden by the partnership deed. WAEC frequently tests Ghana v. Mari, memorize it well. Worked example. On screen. Partners, Femi, capital 80,000 Nigerian Nairas, P&L ratio 2, Goni, capital 60,000 Nigerian Nairas, P&L ratio 1, Hawa, capital 40,000 Nigerian Nairas, P&L ratio 1. Assets at dissolution, land 50,000 Nigerian Nairas, equipment 30,000 Nigerian Nairas, stock 20,000 Nigerian Nairas, debtors 15,000 Nigerian Nairas, cash 5,000 Nigerian Nairas. Liabilities, creditors 40,000 Nigerian Nairas. Assets realized for, land 70,000 Nigerian Nairas, equipment 20,000 Nigerian Nairas, stock 16,000 Nigerian Nairas, debtors 12,000 Nigerian Nairas. Dissolution cost, 3,000 Nigerian Nairas. Realization account. DR, land 50,000, equipment 30,000, stock 20,000, debtors 15,000, dissolution cost 3,000, profit on realization 0. Actual, proceeds equals 70,000 plus 20,000 plus 16,000 plus 12,000 is equal to 118,000. Cost equals 3,000, creditors equals 40,000. Realization proceeds, net of cost 118,000 minus 3,000 is equal to 115,000. Less, creditors paid 40,000. Available for partners, 75,000, less cash already held 5,000 is equal to 80,000 total. Total asset book values transferred, 50,000 plus 30,000 plus 20,000 plus 15,000 is equal to 115,000. Proceeds from sale, 118,000. Loss equals dissolution cost 3,000, so profit on realization equals 118,000, 115,000 minus 3,000 is equal to 0, coincidence in this example. After paying creditors and distributing realization profit/loss, the remaining cash is split among partners to repay capital accounts. If a partner has insufficient capital, Ghana v. Murray applies. The three key accounts in dissolution. 1. Realization account, records asset disposals and realization cost, balance equals profit or loss shared in P&L ratio. 2. Cash/bank account, collects proceeds, pays creditors, dissolution cost, partner loans, and returns capital. 3. Partners' capital accounts, receive their share of realization profit/loss, reduced by capital returned in cash. Summary of dissolution of a partnership. Dissolution causes, agreement, notice, fixed term end, death/bankruptcy, court order. Realization account, book values of assets D aside, proceeds C aside, profit/loss shared in P&L ratio. Payment order, external creditors partner loans partner capital surplus in P&L ratio. Ghana v. Murray rule, if a partner is insolvent, cannot contribute to deficiency, remaining partners bear loss in proportion to their last agreed capitals.